what Professionisti Italiani at Boston is, you want to say two words? And maybe I would like to thank Comites, which is organizing with us this seminar. For the ones who don't know, Comites is the Comitato Italiano all'Estero, and it's a committee of 12 members elected by Italian citizens in the Boston area to represent them towards the local institutions. And there's a comites in every major city in the world. I think the one in Boston we're particularly fortunate. We have a really nice mix of people from different backgrounds and different ages and waves of immigration. So it's a nice representation of the Italians who are here. And Francesca, you want to say two words about PIB?
Yeah, so I think many of you are PIB members, but if you don't know PIB is Professionisti Italiani a Boston, so Italian professionals in Boston. We are an association of about 1,000 members that was founded in 2009. So we celebrated our 10-year anniversary in 2019 with a big Italian expo. So we try to organize events, and when in non-COVID times, also networking events for our members, so we can meet and we create a professional network of all Italians living here. They span different professions, from lawyer to scientists to people working in universities, in pharma, artists, all sorts of professions. So with that, I turn it over to Derek first, I think, or...
Well, I'll make a quick introduction. And first of all, I want to thank you for inviting us to take this journey with you through the great landscape, which is federal and state income taxes. Most of it, the state, we're going to be talking about Massachusetts, as most of us are Massachusetts residents. Over the last 8 months or so, there's been a lot of discussion with regards to federal income taxes. Of course, there's been a change of administration, so there are some potential changes. There's a lot of people that have a lot of palpitation and are concerned about what taxes mean to them. Are income taxes going to get higher? Are they going to impact? Well, I should say they are most likely going to get higher, and how they going to impact us in our daily lives. Joining me this evening to take this journey is Derek Rawls. Derek is partners, and I really won't take the time to go through his extensive resume because we only don't have that much time. But if you go to our website or if you speak with him one-on-one, you will see that he's one of the brightest minds that we have in the Boston area when it comes to income taxes, and not only federal, but state. His expertise is in what we call multi-states. A lot of companies, of course, do business nowadays in more than one state, and that's where Derek is really considered to be at his best. However, he also deals with individuals and individual individual taxpayers. And today's topic is going to be mostly on individuals and really very little on corporations. Maybe I would spend a couple minutes to, or maybe Derek, since you probably have the mouse, so you can take it from here, and let's get going.
All right, thank you, Joe. I want to spend some time talking about the US tax system, which is known as one of the most complex tax regimes in the world. to ensure that I'm bringing awareness to all of you about issues that may impact you directly as an individual. It is clear that if you are a US citizen, you will be subject to taxation in the United States. What I also want to discuss is that there are situations where you could fall under two other classifications. One being that you are a resident of the United States, and the other being that you are a non-resident of the United States. In those latter two scenarios, you would be a citizen of another country. So I want to spend some time today going through what that means and how that could impact you individually on your income tax filing requirements, and then also some foreign reporting requirements that might come into play for some of you, where you still have some real estate, some bank accounts, some financial accounts that are outside of the United States, for example, in Italy, where you may have to report those to the US government. And lastly, we're going to spend a little bit of time talking about the change in the presidency now under Biden to discuss what implications that might have.
Derek, can I ask you to share your slides as slide view rather than individual? So if you go in the bottom, you have a slide view in the full screen.
I can't get that to work right now. Let me.
Okay, anyway, it doesn't matter. It's okay. It's on the bottom, usually in the bottom right. It's
but it's not working. The other way to make it look bigger, if you remove the click to add notes area under the slide, you can drag that to the very bottom, the notes area in the no. In the slide on the right. If you should be able to catch that line, to grab the line. Yes, thank you. And then the one on, perfect, thank you.
All right. Okay. Is that better?
Yeah, they said yes.
Yeah,
Okay.
thank you.
Very good.
Thank you.
Okay, so let's see, this doesn't seem to be advancing my slides though.
We can see your first slide.
It's
right?
It says resident versus non-resident.
yes.
Right.
Yeah.
I can't advance them either, so.
Okay. So if you are a citizen of Italy and you come to the United States and you become a lawful permanent resident of the United States through obtaining a green card, or if you're in the United States for a certain number of days in the current year and the previous 2 years, you are considered to be a resident alien of the United States. And if you are deemed to be a resident of the United States, you are effectively treated the same as if you were a US citizen. And that means that you would be taxed on all of your income, on your worldwide income. So for example, if you are in the United States and you have a green card and you're working in the United States, not only would you have to report to the United States government the income that you derive from your salaries and wages that you're earning in the United States, but if you had a rental property in Italy that you were generating income from, you would also have to report that to the US government. or if you had an investment account in Italy, you would also have to report that to the US government, because they are going to tax your worldwide income, all of the income that you generate. Now, that seems unfair, because you could have a situation where that income that you derive from your rental real estate in Italy might be taxed by Italy and the United States. So what the United States does is they would give you what's called a foreign tax credit, so that you would not pay income to two countries on the same income. And we're going to talk a little bit more in detail about that substantial presence test and how that's calculated in a moment. So this is what I had gone through before. Again, if you are deemed a resident, you have a green card, you're a lawful resident of the United States, you would pay tax on your worldwide income, but you would also be able to claim some pretty good deductions to offset that income, to lower your income tax in the United States. As a married couple, you would be able to deduct about $24,000 as a standard deduction. If you're single, it's about $12,000. That gets excluded right off the bat. If you're working in the United States, you also might be able to lower that income by contributing to a 401k plan. And you can contribute up to $19,500 if your employer provides one of those. And again, that reduces your taxable income to the United States. If you are not a resident of the United States, you are considered a non-resident alien, and your only obligation is to report your US source income to the United States government and to be taxed on that. So if you earned wages in the United States, you would be taxed on those. If you had a US brokerage account, a US savings account in which you earned interest, the US government would tax you on that income. Or if you had real estate that you were renting in the United States,
Go.
on that by the United States.
Derek, sorry to
If you wanna,
you. Are you advancing the slides or not? Because we are still on slide 1.
And
I can, I am so sorry. I can see.
Okay, maybe you can do a slide show if you can. Maybe it's easier. Or let's go back to your thumbnails so you maybe you can advance through those.
Derek, probably you have 2 screens, correct?
I have 3 screens.
Yeah. So what's happening is probably you're moving slides, but the slide is moving on the other screen. So maybe what you need to do is to, on Zoom, you can choose which screen you share. If you go on share screen down in Zoom, you can choose the screen that you share, and you can pick the screen where you see the slides advancing.
Okay, did that change anything?
Not yet.
No. So you can stop sharing this and start sharing again. Maybe that helps. Okay, now we see number 3.
now we moved.
You can see, okay, you can see that now?
Number
Right.
3. Yeah.
Slide number 3.
Okay, perfect. And you can still see it?
Now
Now
your desktop.
your desktop. Now we see it. Now we see it.
Now we see all the participants.
Yeah, because he stopped sharing. He's probably re-choosing the proper screen now. Okay.
Okay, you can see 3 now?
Can you try to advance or go back and forth to the slide so we can see if this is the right screen?
Yeah.
Well,
Moving?
no, it's not moving. because we're still seeing, yeah. Haha, yes, I think we're done. This is the good one.
This is number 4 now.
Yes,
Okay,
yes,
now-
it's
now
moving.
Okay, you got
Moving. Okay, good. We are in business.
it.
Thank you.
Okay, good, good.
Big
I'm
step
sorry
forward.
about that. So just to make sure that I want to go back to a situation where we're a non-resident alien and you have some income because you're renting real estate in Italy, you would not have to report that to the US government. Let's say that you have a brokerage or an investment account in Italy, you would not have to report that to the US government. So this is key to determine whether or not you are a resident or a non-resident, because if you're a resident, all of your income gets reported to the US and you get some relief with that foreign tax credit to the extent that you've paid tax to another country on the same income. But if you're a non-resident alien, you're only reporting your income that is related to your activities in the United States.
But Derek, there most likely is the same credit in the country that, let's say, the taxpayer is a resident of. Like in Italy, you do get somewhat, it's not a big credit, but you do get something for taxes that you have paid to the United States on that same income to avoid, once again, the issue of the double taxation.
Right. So again, this just goes back to the fact that if you are a resident, if you're residing within the boundaries of the United States, you have to follow the laws, similar to if you are a US citizen and file a tax return and report all of your income. And if you're a non-resident, you just are, you get to exclude your income outside of the United States from taxation. And there's some very detailed publications on this that this slide references, but we won't go through that in detail. I said at the very beginning that to determine if you are a resident alien, it would either be because you have a green card or because you meet the substantial presence test. And that number of days that you would have to reach to meet the substantial presence test is 183. But there is a little bit of a complicated formula to determine that. You have to be in the United States for at least 31 days during the current year. And then you look back to the first year prior to that. So 2021 is our current year. If we've been in the United States for more than 31 days in 2021, we would then go back and look at 2020, and we would multiply the number of days that we were in the United States in 2020 by a third. And then we would go back one more year to 2019, and we would multiply the number of days that we were in the United States in 2019 by 1/6. And then we would add them all together to see if we are over 183 days. And if, according to that complicated formula, you've been in the United States for more than 183 days, you are deemed a resident, regardless of whether or not you have a green card, you would be a resident. And again, you would be taxed on your worldwide income.
So Derek, sometimes the question that we asked is, well, I haven't been in the United States 183 days in this last year, and therefore I'm not. But as you can see from this formula, you don't have to have 183 days in the current year to qualify and to end up being deemed a resident, and therefore have to bring your worldwide income into the United States.
Yep, that's a great point. And that's really, one of the purposes of us, having this conversation with you is just to make sure that everybody is aware of this and checking in to make sure they're not missing anything, because it might not be intuitive that this is how the rules would work. When you're a non-resident and you are limited to taxation on your US source income only, you do have a couple of disadvantages. One being that you don't get that $12,000 standard deduction for a single person or $24,000 standard deduction for a married person. You do not automatically get that if you are a non-resident. You could itemize your deductions and get to deduct income taxes that you've paid to states or other expenses that might be directly related to your US income, but you do not have those standard automatic deductions. Also, you might not be able to file married unless your spouse is a US citizen. And depending on whether you file single or married could affect your income tax brackets. And then the last thing to keep in mind is that your income from your wages or from businesses that you operate in the United States are taxed at the same rates as a US citizen, but your income on passive investments, like interests or dividends or capital gains, are typically taxed at a flat 30% rate. So that's a little bit different than a US citizen or a resident alien, because the US has very favorable tax rates for capital gains and certain types of dividends that you would not be able to take advantage of.
And what I want to bring up here is the difference in really the file form, because as you can see, for a non-resident, that's what NR stands for. But yet if you are a resident, it's file form 1040. And we're always been asked, okay, why is it that I'm filing an NR and not a 1040? And it makes a big difference with regards to where and which form you should be filing.
There are also treaties which exist between the United States and other countries such as Italy. And sometimes that can have some special implications for your tax situation. Maybe you wouldn't have to use that 30% rate on certain types of income. And there can be other arrangements between the countries to make sure that the individuals are being taxed fairly between the two countries. And Joe, I don't know if there's anything specifically of note here with respect to the US-Italy tax treaty. I can't think of anything off the top of my head.
No, except of course, that what happens is that under the Italian laws, especially when you're talking to real estate, like depreciation is not allowed. The deductions allowed on a rental property are a lot less under the Italian code than they are under the US code. So you always get this big difference, where for let's say for the US, the rental activity could end up being a loss. And then for Italy, though, it ends up being taxable, and they don't get that benefit because the US says, well, that's too bad. I mean, we wouldn't have taxed you. So that tax that you end up paying in Italy doesn't give you a benefit in the US. That's the only thing I can think of.
One of the most important things is that when you file a US tax return, either as a resident or a non-resident, you have to have an identification tax number. US citizens have a social security number that is requested and issued at birth. But in this case, you might have to fill out a W-7 form to request that you get a tax identification number. It's a one-page form, but there are some boxes that you have to check to explain why you're applying for it. So, you know, there's could be some questions that come up on that. If you're filing as a non-resident, that's one of the boxes that you would check to explain, you know, why you're requesting that information. And there's a renewal period that occurs every few years where you have to go and just renew your number. But that's how the Internal Revenue Service tracks you and ensures that you filed your income tax returns.
Yeah, and of course, green card holders have a social security number that is provided to you on the day that you arrive to the country. So once again, you can see the similarity between a green card holder and a citizen. And there are, when it comes to income taxes, there are none. They're treated exactly the same way, except a green card holder may have some additional filing requirements if they still have some assets in a foreign country.
There are certain circumstances that don't meet the general rules that we've been discussing here that could exempt somebody from taxation in the United States. There are some special rules for professors and teachers that travel from Italy to the United States to teach, and for students that come into the United States. So, so we want to make you aware of those.
And that's most likely because that income is going to be taxed in Italy to the recipient, and therefore because of the treaty that they have between the two countries, and because it is of a short duration, they allow this income, although earned in this country, not to be taxed in the US.
And those exceptions are usually dictated by the type of visa that you would have for coming into the United States. And this is a slide that's probably difficult to read, but this kind of goes through, different visa types and the implications that you would have. I might pause there for a minute to see if anybody has any questions. We can hold them for the end, but we're going to shift gears a little bit here in talking about foreign bank reporting. But if anybody did want to ask a question, I'm happy to take it at this point in time.
A question I want to ask, I don't know if you can hear me. Are you gonna cover the responsibility we have with Italian taxation? So filing in Italy if we live permanently here. In my case, I'm a dual citizen.
This presentation, we're going to focus on the U.S. tax, U.S. taxes. We're not going to cover the filing requirements in Italy, unfortunately. But if you would like to send an email, we might be able to help you as a follow-up, if that's okay.
I would appreciate. Thank you so much.
Okay. One of the things that catches people by surprise is what we call foreign bank and financial account reporting. These rules apply not only to US citizens, but they apply to resident aliens. So if you meet the test to be a resident of the United States, there are requirements that you report your foreign bank account holdings or financial holdings outside of the United States that are more than $10,000 in value. The reason that these rules exist is the US government is trying to monitor and prevent people from moving assets outside of the United States where they can earn income and avoid taxation in the United States. So these rules are intended not for everyday people. These rules were really put in place for criminals and money launderers and people like that. But all of us have to comply with these rules. And sometimes this gets missed. So this is very important that as part of the filing of a US individual income tax return for a resident alien, that you have special reporting requirements where you disclose your bank accounts outside of the United States and your average value of those balances. And there are some fines if you do not comply with these rules. And that's what's unfortunate about it, is that it's not intended, you know, for most people, nobody's trying to do anything wrong by having an account in a foreign country. It might be because you've moved from Italy to the United States, or you've inherited assets from family members outside of the United States. And it's just a compliance exercise. But if you don't comply with these rules, there can be some pretty severe penalties. So we want to make sure that everybody listening understands that. If you are a non-resident of the United States, you do not have to comply with these rules.
And Derek, with regards to these rules, they apply to all kinds of situations. You also have reporting requirements if you are a resident, once again, a green card holder, and you inherit assets, in Italy, let's say, because we're talking in Italy, then you have some reporting requirements here. The government wants to know what have you inherited. In other words, what assets now are in your name, because someday you may want to dispose of those assets. You may want to, liquidify them and bring them in as cash into this country. So it is always important when you find yourself in a situation like that to seek advice, professional advice, to make sure that you're doing the right thing, because you may think, who's going to know, or what, it won't matter. But then you find yourself in a situation someday into the future that you're stuck with these assets. And because you haven't done the right reporting, now you don't know how to handle them. And if you end up doing the right thing at that time, it could cost a lot of in penalties and whatever. So that's something to keep in mind. With regards to the annual reporting, the government, the U.S. government is interested mostly in bank accounts and investment accounts. It is interesting because we have looked into that, and as you know, a lot of our parents used to go to the post office and set up accounts at the post office. By the way, the government doesn't want you to report those. There's an exception to that. I don't know why. Maybe because the government already knows that you have those accounts, and they don't need to be reported again. So that's an exception to the rule. Also,
sorry, I have a question. What about real estate, like apartments that are not
yes.
rented, but they're just there and doing nothing basically?
Yeah, if you own some assets that you just are not, they're not earning you any income right now, then there is no reporting. At some point, depending on what you do with those assets, that's when you have some requirements. But if it is just a non-earning assets, then you have nothing to report to the government.
Okay, thank you.
Sorry, I have a question about insurance contracts. So if the US resident is a beneficiary of an Italian insurance policy, do we need to report the insurance?
We came across that just in this past year, and the answer is yes. We did some research, and the conclusion was that needs to be reported.
Thank you.
You're welcome.
And it's always better to over-report than under-report. It does not result in additional tax. It's just reporting what those accounts are and what the average balances are in them. So it's merely a reporting mechanism. And there's two thresholds for the FinCEN Form 114. It's for accounts that are over $10,000 in value. And then there's another form, an 8938, that relates to assets that are worth more than $50,000. I also want to talk a little bit about withholding. There are situations where a U.S. payor to somebody that is not a U.S. citizen that has a foreign address, this is mostly pertaining to non-residents, they will withhold federal income taxes at the time of payment as a mechanism to ensure that they capture the tax on that income. And then when you file your tax return, you would report that withholding as a payment against the tax. Some of the withholding rates are very high, and there are some opportunities to file some forms that alleviate either the withholding altogether or reduce the rate. And those forms are the W-8BEN predominantly, and then there are some forms related to those issues. So if you have a situation where the withholding is taking a place or you want to prevent it, those are some opportunities that we could look into to help you claim an exemption from that withholding pursuant to the treaty with Italy.
An example of this withholdings came about recently. An individual, a U.S. resident, worked for a U.S. company, had a 401k, contributed to the 401k over the years. Then he decided to leave the country and move back to Italy, but he kept the 401k plan here in the U.S. And after he passed away, and the beneficiary of that 401k plan was one of, I believe, was a nephew or a brother. And unfortunately, it's not that easy at that point to get the money out of the US bank. Had he requested that money, it would have been no problem because he had a social security number. He was registered here with the taxing authorities. He would have had to file a tax return, pay the taxes, and that would have been the end of it. But because he had passed away, and now the beneficiary is a foreign, an alien, not a resident, it created, I don't want to say a mess because we were able to get through it, but all of a sudden this individual had to now get what Derek was talking about, get a federal ID number, which was not that easy because here he is in Italy. Now he had to go to a US consulate in Italy to get apply for the federal ID number and get the federal ID number. Then we had to send it to the bank here, and the bank, before they issued the money, they withheld the 25 or 30%, which means then that the individual had to file a tax return here in the country and settle up with the government. And all that would have been avoided if the individual at some point, had taken the money out of that 401k and paid the tax and trued up with the US government. So these things, if you don't settle them, they're gonna come back and bite you in the behind. It's not one of those things that unless you wanna lose the money, it's, someday somebody else has to deal with it, and it's never easy.
Yeah, but Joe,
Yeah.
I think this is a very common situation in which we work here and then maybe one day we retire in Italy and then we keep our 401k here because that generates monthly.
It's earning well, right, sure.
And then if we have a heart attack, all of a sudden, right, it's not that we when we move to Italy, we want to bring with us the 401k because we may be retired in Italy, and then we want the monthly income from that income. So I think
I understand that, and that's exactly what I was going to say. The moral of the story is not to contribute to a 401k when you're here, while you're working here, because it's one of probably the best tax deferral attributes that we have, but to also pay attention and to keep that in mind as you go through life. Sometimes we forget, and so just know that that could be an issue if you leave that to somebody else to deal with after you're gone.
Understood. Yeah. Thank you.
You're welcome.
I want to spend a few minutes as we conclude our presentation to talk a little bit about the impact of Joe Biden being elected president of the United States. So we'll go through this fairly quickly because he has not done anything yet. And, of course, it's to be seen what he tries to pass and when. He has support now in both the House and the Senate, where the Democrats can control both the White House and both the Senate and the House. So there is an opportunity, if all the Democrats banded together with the president, to pass something. But given the pandemic, we do not anticipate any tax increases in the short term over the next year. We think the focus is going to be on stimulus. But at some point, because of the debt that the United States will take on with a lot of these relief provisions, there will be a need to increase taxes. And those tax increases will be borne by high income individuals. And Joe Biden is defining those as individuals or families that are making more than $400,000 a year. And when he was campaigning, I'm going to go through what he was proposing as law changes, but I'm sure that will evolve depending on what the economic climate is and how much support he can get from his Democratic colleagues. The top marginal income tax rate in the United States currently is 37%. And we have a graduated tax rate system where the rates go up as your income goes up. And so those rates range from 12% to 37% currently. What Biden proposes to do is raise that top individual tax rate back up to 39.6%. And this is the highest marginal rate that was in place before Trump changed US tax law a few years back. And that rate would kick in with incomes over $520,000 for singles and $620,000 for married couples. The next thing that Biden is looking to potentially do is raise the tax rates on capital gains. And currently they're capped at 20%, but for people making more than $1 million in a year, he would like to increase those to the same rates as those imposed on ordinary income. So that could get up to 39.6%.
And that could impact a lot of our participants who may have stock options and who over the years have benefited from that lower rate. And all of a sudden, you can see that the tax that you're going to be paying on those gains, especially if your income is over that $1 million, which includes the capital gains, right, Derek?
Yes.
Then all of a sudden you're paying double the tax. So this is a situation where some of us not me, I don't make that kind of money, but the people that make that kind of money have to take a look and say, okay, let's figure out when do we pull the trigger and maybe exercise those options if you know that in the future your capital gains rate is going to double.
Right, and a lot of people that don't make $1 million a year might have 1 year where they sell their business or sell something significant, and they have a very large capital gain, and because they have that event, their income can go above the $1 million, and that's really where this could be very significant, as Joe was talking about earlier. The other thing that Joe Biden is looking to do is there's a major concern about funding Social Security benefits. And a resident alien does pay into the Social Security system in the United States. And currently, the income that is subject to Social Security is taxed at about $137,000. And what Joe Biden is proposing is that he would keep a similar cap at about $137,000. And then he would stop charging Social Security taxes. But then when the income got over $400,000, he would begin charging it again. So they call this a donut hole, meaning that you would get taxed on Social Security up to about $137,000, and you'd have no tax between $137,000 and $400,000, and then the Social Security taxes would begin on income or wages earned above the $400,000 mark. And again, this is going along with his theme that somebody that makes $400,000 or more is high income. That's how he's defining it, whether that's an individual or a family. For self-employed or small businesses that are operating as a partnership or an S corporation, there is currently a deduction that could reduce 20% of the income from that business that is being taxed. That's called the qualified business income deduction. This was part of Trump's tax reform, and Biden would like to do away with this, or really focus more on those, again, earning over $400,000, where you would not have an opportunity to take that deduction anymore. And then we talked a little bit about itemized deductions, where you can deduct certain expenses such as state income taxes, mortgage interest, charitable contributions. Biden may limit those itemized deductions for taxpayers that are making over $400,000. Currently, there is no limit. There are some limitations on the amount of state taxes you can deduct. Those cap at about $10,000. But under Biden's plan, he's going to manage that a little bit for high income people to potentially limit those deductions. And then the corporate tax rate, Biden is looking to increase from 21% to 28%. Also in the United States, whether you're a citizen or a resident, you would not have any death taxes or inheritance taxes on your estate. Currently for estates that are under about $11 million, there would be no taxation. For a married couple, that would be $22 million. Joe Biden is looking to reduce that amount to make it more difficult to pass on assets to your heirs when you pass away. He wants to drop those thresholds down to about $3.5 million for an individual and $7 million for a married couple. And that's been a hot topic, for a lot of people, discussing, any planning where they were looking to minimize their taxes upon death.
By the way, the Massachusetts limitation is 1 million per individual, 2 million for a couple. But of course, the tax rate is much less. The tax rate, I believe the highest rate is 16% in Massachusetts. Right, Derek?
Yes, that's right. And that's the material that we wanted to go over with you. And I know that Francesca said that this is being recorded. If anybody would want to refer back to it, we're happy to share any of the slides that we've presented to anybody. And we are happy to answer any questions that anybody has, or if after the presentation you think of a question that you didn't ask, you can email us and we would be happy to help you with any of the questions that you might have.
Great, thank you so much. This has been very informative. Please feel free to unmute yourself and ask your questions.
This is Lorenzo. Can you hear me?
Yes, we can hear you.
Thank you for your great presentation. It was very interesting and informative. I have a question for you that may be more of a legal, like for my immigration lawyer, which already replied to me, but I just wanted to know your point of view. So I hold a H-1B, and based on what you said, I'm definitely like a resident alien because I've been in US for 10 years and definitely last year more than 183 days. I was just wondering, because I have my primary employer with H-1, and then I have multiple concurrent H-1 visa for which I get W-2s. I was wondering if in any of them I can get a 1099, or since I still have H-1, but I'm still I don't have the green card, I still need to get W-2 and not a 1099.
Lorenzo, I think that you would get a W-2 based on your status as an employee.
Absolutely.
With your employer. And if you are regarded as an employee, they must issue you a W-2. The only way that they could provide a 1099 is if you are deemed not to be an employee and you are an independent contractor.
But that's basically, it's based on my immigration, based on my visa, because I have like a main employer, and then I work as an associate in other practices. So I'm not really considered an employee, but the fact that I have a H-1, I think I still need to get a W-2 because I'm not a green card holder or a citizen, I guess.
We would have to look into that. I mean, I really offhand, I don't know the answer to that question.
Okay. No, I wonder, it was more of a legal issue.
Yeah, right.
Thank you very much.
Sure.
Any other question?
Hi, I'm Adriano Scrivoni. Can you hear me?
We can hear you.
Hi. Thank you. And I just wanted to make a question about, we always speak and you always spoke about the federal tax, but what about the state tax? Because the real issue is that the treaty are only with the federal state and not with the state like Massachusetts. So the problem of the income for green card has us, Italian green cards here, that about the income that we make in Italy, that is true, that is not taxed again here because of the deduction, the credit, but it's true only for the federal taxation, not the state taxation. So that means that we pay tax in Italy, and then usually higher than in the United States, and then we have to pay tax here again for the state tax. That means we pay 2 times. That's our situation.
That is true. That's just the way the way that it works. The state of Massachusetts does not have the treaties at the federal level. They're not at the state level. So you're right. You would be paying that 5%, an additional 5% to that income already taxed.
Exactly. As you know, Joe, I'm being a lawyer with a practice in Italy. I have to pay much higher tax there than tax I would have paid here, and then I have to pay again here the state tax, unfortunately.
But in regards to that, this worldwide taxation, I thought that there were treaties with Italy that you only pay the difference.
But only for federal tax. We are
Only the difference,
state
yes.
tax. That's the issue.
Ah.
Massachusetts state tax is 5.5, if I'm right, and you have to pay that. I mean, you cannot do anything.
You're absolutely right. There is nothing right now that that gives you, you know, a position to stand that you say, I've already paid that tax and therefore I shouldn't be paying a tax on that.
But you can deduct your state tax in your federal tax.
You used to be able to deduct all of the state income taxes that you pay, but when Trump passed his law a few years ago, he caps that deduction at $10,000. You can't deduct any more than $10,000.
Ah, okay.
So,
But the problem is that the income that you produce in Italy is not taxed here because you pay the tax over there already. I mean, it's taxed here by your deduction, but on that income, you have to pay state tax anyway. So that's the issue. You pay there 40%, you don't pay anything here, federal tax, but you have to pay another 5% here, 5.5.
What I'm trying to say that's what you pay to the state, then you can deduct the.
Yeah, but you don't have to pay income tax on the income you made in Italy because you already paid there. So you cannot deduct from nothing. You know what I mean? So
In Italy, the one that you pay in Italy, no. The one that you pay to Massachusetts, yes, though.
no, but I mean, the tax you pay in Massachusetts, state tax, you can deduct from the tax you pay in federal tax here. But if you already paid tax in Italy, you don't have to pay federal tax here, but you have to pay state tax.
the Massachusetts taxes that you pay then are eligible for a federal deduction against the income, all income. The issue that we have though is that under the Trump plan, there is a limitation, and all taxes, all state taxes, meaning real estate taxes, excise taxes, income taxes, cannot exceed $10,000. So in states like Massachusetts, where we have a heavy, real estate tax, it doesn't take much to put you over the top, which unfortunately you do not get a benefit from that.
Yeah, but Adriano, so you are considered here a non-resident.
No, I have the green card here.
So you have to file federal.
I do. What I mean that because of my income, I'm a lawyer, as you know, I practice in Italy. So the income that I make in Italy, I already pay the tax over there because it's produced there. So when I am going to file income, the federal tax here, I can deduct the tax paid in Italy already. They are much higher than here, but I still have to pay the state tax here.
Yeah, there is no, yes, you get no credit for it.
That's my little nightmare.
There's nothing.
It's unfortunate because you should be able to exclude the income from Massachusetts return that was taxed in Italy, or get some sort of a credit of, for the tax, for the income that you paid tax to Italy.
But you can't right now.
You can't. There is nothing in the statute that allows you to do that.
So somebody, actually, a couple of people in the chat are asking if you know about any different taxation between Italians living in the United States as even as residents for tax purposes, and the ones that are in the IRE, the list of Italians living abroad. Have you ever heard about it?
It's the same thing. I mean, an Italian that lives in the States has to be in the IRA list and then has the green card.
I don't know what.
I think the question is more about what is a tax situation obligation in Italy for Italian citizens that are resident in the US.
There was
more about, at least that's how I read the question. I think Carolina sent that question. I think that's the way I read the question.
Yeah, you are right. So
if I can, Joe, if I can, it's pretty simple. you have to file tax in Italy for the income you make in Italy.
Right.
And that's it. And then you file in the States the income you make in Italy with the deduction of the tax paid over there and the income you make in the States.
Yeah, the big difference is that Italy's system is a territorial system. So it works on what you produce and you make in Italy, regardless of where you live, where you are. While the US is a worldwide taxation system.
The United States is unique. It's one of the few, I think there might be one other worldwide taxation systems. So it's a little bit different.
Yeah, but in this specific case, on the contrary, it would have been the same, because an American citizen that lives in Italy has to pay tax for the income made in the States anyway in the States. So this is not the situation which you see the difference. You know what I mean? It's right that the United States has worldwide taxation and not Italy, but it depends on the income. If it's produced in assets in Italy, you have to pay in Italy because they are produced there. It's the same otherwise.
The treatment is the same.
The difference, I think the big difference is that if you're an Italian citizen, you earn money in the US, there are no obligation of reporting your US income.
If you're a resident in the States, is right.
If you're a resident in the state, and that's the difference between a worldwide
absolutely.
system.
The worldwide taxation, this is yes, it's just unique. Yeah.
So
to that, I have a question. This is Fiamma Zamoni. I have a dual citizenship, Italian and US. And through my employer, US employer here in Boston, I now have the opportunity in this virtual world to move back to Italy, work in Italy, but receiving a US salary. So I'm contributing for 401k, paying taxes here. Where would I pay the taxes? In Italy or the United States? Being a US citizen living in Italy.
So if this is to consider temporary transfer?
Could be also permanent.
Well, I think right now the way they are looking at it is that it's a temporary transfer, and therefore they're paying you in US dollars. They the money in the transaction, everything is happening at this level, so that you are deemed to be a US resident, and that money is deemed to be earned in the United States and not in Italy.
Okay, so I would just be paying the taxes in the United States.
That is correct.
And not in Italy. Yeah. But would I still be able to get medical services?
I do not know. I don't believe so. I think you better check into that.
Okay, that's probably the issue, right?
Yes, I don't think you will. I don't think you qualify.
Okay, thank you.
So that brings me also to the situation of the person retiring in Italy, and we will live on our 401k. So we will have to pay taxes in US, but not in Italy, because the income will come from US.
That is correct.
Francesca.
Yeah.
It's Matteo speaking. I'm sorry, I'm intervening. In fact, I asked to make a question because I am in exactly the same position we are talking about here. I was obliged, of course, to move back to the US. I moved here before, but now with the COVID, I could not come back last year. So my first, regarding to the woman that talked before, I am back being a resident in Italy, but I make my money completely in the United States because I teach for college. So all my stipends are there. And so far I've been paid the US taxes regularly as I was living in the US. Now I'm back as a resident in Italy, and actually I can use the Italian health insurance and so forth. But of course, what I'm doing is I'm declaring in Italy as well exactly what I'm making. And so far, they didn't ask me any compensation in Italy for what I'm making each year. I've been doing this actually for many years. I've been, presenting my entire U.S. declaration to the Italian federal government, and so far nothing happened. And because it has been happening now for possibly 10 or 12 years, I think that must be, a situation that has been accepted. My question is, for the fact that I did not come back to the U.S. For 1 year, is going to change something for my situation as an American abroad? I am actually an American citizen because I did not reside at all at the end in 2020 in the U.S. But still, of course, my income is coming almost completely from the U.S. Is there any change in the situation if you stay away, once again, as an American citizen, if you are temporarily abroad? That's my question.
I mean, that's a legal question more than an accounting question, but
okay.
Is that because you are a citizen, the answer is no. Had you been a green card holder, the answer would have been totally different.
Yes,
okay, thank you.
As a U.S. citizen, you are taxed on your worldwide income unless you renounce your U.S. citizenship. And that's a complicated thing to do because they might try to tax, certain appreciation in some of the assets that you hold. But as long as you're a U.S. citizen, you'll be taxed on your worldwide income. And I know that the states have been having some difficult issues with COVID and where people are working. They used to go into an office in Boston, but maybe now they're working at home in New Hampshire. And so this COVID issue has kind of, created some confusion about where income really belongs because the COVID situation is deemed to be temporary. So I think that's why they continue to treat you as being paid from the US, even though you're working remotely in Italy.
But if my situation will change and I will, find a job here, of course, remaining a U.S. citizen, I would have to declare simply what I'm making here and paying my taxes here in Italy and declaring to the U.S. the situation.
Yes.
Yeah.
Yes, because when you are American citizen, you are worldwide taxation.
No, I knew that since the beginning, but my situation might change. So, okay.
You still be American citizen forever. So.
I'm afraid so. It depends on the presidents, though. If it would have continued with Trump, I don't know. But anyway, I'm joking, of course.
The Yahoo or the Google CEO, whoever he was, not to pay taxes, right? So, and to claim, just one last question, to claim that foreign credit that you mentioned, how does it work? Is there a minimum? You have to make more than a certain amount to claim that, the foreign credit in the federal?
When you file your US income tax return, you determine what income is from the United States and what income is from foreign sources. And you calculate a percentage. So if 20% of your income is from Italy and 80% is from the United States, you effectively could reduce your US taxes by 20% as long as you paid that amount in taxes in Italy. So there's a formula. It's a little bit complicated, but you have to pay tax to the foreign jurisdiction, and it has to be income from a foreign source to get that credit.
Yeah, got it. Okay, since I think we asked many questions, unless somebody has any burning question, then I think we can end here because it's already 7:15. So with that, I would really like to thank Joe and Derek. I mean, we could go on for hours here. but I think better to stop here. So this has been very, very informative. I learned a lot. Thank you very much. We really appreciate. I think it's been very useful. And again, we were going to post the recording on our website, piboston.org, and maybe we can share also the slides if you agree.
Okay.
Yeah, we can send them if you don't have them, sure. And thank you very much for having us. And if any of you have any questions in the future, just shoot us an email, and to our ability, we'll make sure we get you an answer.
Yeah, they are the best.
Thank you so much.
Thank you.
Thank you.
Bye-bye, everyone.
Bye-bye, everyone.
Bye-bye.
Bye-bye.
See you soon. Bye-bye.
Thank you. Bye.